Hello, Rick Komarek, Certified Financial Planner here, coming at you with a brand new article that I just uploaded to my blog. And this one's called Timing Isn't Everything. So let's take a look at this. Over the course of the summer, which we're enjoying right now, it's not unusual for the stock market to be a topic of conversation at barbecues or other social gatherings. You might have a neighbor or relative or someone like that ask you, which investments do you think are good at the moment? And the lure of getting it right by timing or avoiding the next downturn may be tempting even to disciplined long-term investors. The reality of successful timing markets, however, isn't as straightforward as it sounds. Outguessing the market is difficult. Attempting to buy individual stocks or make tactical asset allocation changes at exactly the right time presents investors with substantial challenges. First and foremost, markets are fiercely competitive and adept at processing information. During last year, an average of 462.8 billion in equity trading took place around the world. The combined effect of all this buying and selling is that available information, from economic data to all the different investors' preferences and so on, is quickly incorporated into the current market prices. Trying to time the market based on an article from this morning's newspaper or a segment from financial television, it's likely that information is already reflected in prices by the time an investor can react to it. Dimensional recently studied the performance of actively managed mutual funds and found that even professional investors have difficulty beating the market. Over the last 20 years, 77% of equity funds and 92% of fixed income funds failed to survive and outperform their benchmarks after cost. Further complicating matters, for investors to have a shot at successfully timing the market, they must make the call twice to buy and to sell. Professor Robert Merton, a Nobel laureate, said it well in a recent interview with Dimensional. Timing markets is the dream of everybody. Suppose I could verify that I'm a 700 hitter in calling market turns. That's pretty good. You'd hire me right away. But to be good market timer, you've got to do it twice. What if the chances of me getting it right were independent each time? They're not. But if they were, that's 0.7 times 0.7. That's less than 50-50. So market timing is horribly difficult to do. Time and the market. The S&P 500 index has logged an incredible decade. Should this result in investors' allocations to equities? Well, Exhibit 1 suggests that new market highs have not been a harbinger of negative returns to come. The S&P 500 went on to provide positive average annual returns over 1, 3, and 5 years following new market highs. So the conclusion is that outguessing markets is more difficult than many investors might think. While favorable timing is theoretically possible, there isn't much evidence that it can be done reliably, even by professional investors. The positive news is that investors don't need to be able to time markets to have a good investment experience. Over time, capital markets have rewarded investors who have taken a long-term perspective and remained disciplined in the face of short-term noise. By focusing on the things they can control, like having an appropriate asset allocation, diversification, managing expenses, turnover, taxes, investors can better position themselves to make the most of capital markets and what they have to offer. If you have any questions about retirement, investing, or your financial plans, feel free to call me anytime.